Hello, I'm McCray Sykes, Gabelli Funds Portfolio Manager and sole Portfolio Manager of the Gabelli Financial Services Opportunities ETF, symbol GABF. In today's webinar, we will discuss the financial services landscape and how to take advantage of catalysts in the market. The fund was founded on the belief in the American tailwind of prosperity, a concept championed by Warren Buffett. Essentially, the American economic system has generated incredible opportunity for corporate and household wealth progress. By example, in 1971, household wealth was $5 trillion. Today, it's $176 trillion, or an increase of 35 times. GABF seeks to own companies that are well levered to this tailwind: wealth and asset management, payments, banking, insurance, and other specialty financial companies. In aggregate, we have compiled a portfolio of great businesses that offers compelling value as measured by a lower earnings multiple compared to the S&P 500 index, and at the same time, superior expected earnings growth. Further, we see ample catalysts due to the change in regulations, a normalized yield curve, and government pro-growth policies. Thank you for tuning in.
Good morning, and welcome to today's webinar where we will be discussing the financial services sector and the long-term power of the American tailwind. I'm Audrey Melville, Marketing Director here at Gabelli and our moderator for today. I'm thrilled to be here with McCray Sykes, Portfolio Manager of the Gabelli Financial Services Opportunities ETF, GABF. Gabelli is a global asset management firm founded by Mario Gabelli in 1976. Today, we manage over $35 billion in client assets across value, growth, fixed income, and convertible securities through open and closed-end mutual funds, separate accounts, UCITS, and ETFs. Our dedicated teams of analysts and portfolio managers conduct fundamental, bottom-up research utilizing our firm's trademarked private market value with a catalyst investment approach to identify companies selling at less than their intrinsic value. Today, we'll be discussing the GABF ETF, which is a part of our ETF product lineup at Gabelli. We currently offer 5 actively managed thematic ETFs and are launching more ETFs in the coming months. Mac is a portfolio manager for the Gabelli Equity Trust and is the sole portfolio manager on the Gabelli Financial Services Opportunities ETF, an actively managed ETF investing in the financial services sector. Mac has over 28 years of industry experience and was ranked the #1 investment services analyst by the Wall Street Journal in 2010. Mac, thanks for joining us today.
Thank you for having me.
Before we kick off our Q&A, can you tell us and our audience more about GABF?
Yeah, so I'm proud to be a portfolio manager for one of our 5 ETFs that we launched. This summer in June, we achieved our 3-year track record, and so we're very proud of the performance we've put up since our inception. We did get to ring the closing bell of the New York Stock Exchange to commemorate that opening. And we see lots of opportunity going forward as we talk about the American tailwind and all these companies that are best of breed in the financial services in terms of great secular tailwinds, whether it's asset and wealth management, insurance, payments, and in other services companies as well. So we like the positioning, we like the sector, and we're very proud of our track record right out of inception.
Great. Well, congratulations on the 3-year track record. So let's talk more about the American tailwind. Can you tell us more about this industry dynamic and how GABF is poised to benefit?
So this was a term first coined by Warren Buffett, and it refers to the economic system that's been in place in the US. And you think about the corporate competitiveness, the capital allocation, innovation, entrepreneurship, all of these things that are powering the American economy today. We have both the corporate side and the household wealth side. And as we mentioned before, we've just had tremendous progress in it. And one thing that we look at very closely at Gabelli is that household wealth meter. And going back to, say, 1971, the total was about $5 trillion in the US. As of 2Q25, there's $176 trillion. So that's a 35-fold increase. And so you think about that progress, I mean, it's just tremendous. And that is the tailwind for a lot of the benefits to financial services. So as I mentioned, those companies before in different sectors within financial services are very well levered to that growth and prosperity. And we think that is a major theme for investing in the ETF.
Great. That's a helpful explanation of that theme. So building on that, could you highlight some of the unique features of the GABF ETF and its role within an investor's portfolio?
We are specialized, but we have some pretty incredible companies. And you think about Berkshire Hathaway or JP Morgan or American Express. These are great American companies. They should be in everybody's portfolio, but we have a very bespoke collection of businesses that go into this. And when we look in aggregate at the portfolio of currently about 40 names today, the price earnings ratio is about 15 times. As everyone knows, the S&P 500 is about 22 times. And then if you look over the next 3 to 5 years in terms of expected earnings gains, so fundamental growth of intrinsic value, it's about 14 times, 14% and 12% for the S&P. And then operating margins, we have about 33% versus 28% for the standard company in the S&P. So when you put it all together, fundamentally, we have very competitive earnings gains at a compelling value with companies that are stronger than in aggregate of the S&P 500. So we feel pretty good about the positioning of the portfolio as well as the opportunity going forward.
So how do you define a great business and why should investors care?
So I always find this fascinating that when you have a health issue or you treat your health, you always look for the best doctors, the best institutions, the best advice, but yet people veer off and buy some of the worst companies. And if this is important, your investment health or your financial health is just as important as your overall health. So we want to construct a portfolio of best of breed companies, the strongest, the best performing, the most entrepreneurial companies. And again, I mentioned Berkshire Hathaway and JP Morgan, American Express. There are a few of those. We don't need to kind of explain. I think people understand those brands and how they execute. But that's a big focus of us. And in terms of selection and wanting these companies to compound over time. And we think that, look, if you want the best advice for your health, you should have absolutely the best advice and investment in capital allocation for your investment portfolio. And that's what we're trying to accomplish with this ETF.
Great, thanks. So at Gabelli, we talk a lot about catalysts. So why are catalysts and economic themes important for portfolio selection?
So we do like to buy companies at a discount to intrinsic value. That just is our basic ethos here. But it's not enough just to find a cheap company relative to where it should be trading at. You need a catalyst to narrow that gap. So you can be sitting on companies that are undervalued for years, but that doesn't really help your returns. So today, there's a number of different catalysts within financial services. I think one of the biggest categories is regulations. And then you can break that down into several different buckets. So at a top level, for banks, for instance, there's a change in regulatory environment in terms of their capital requirements, SLR, Basel III, a couple of things like that. I'm sure people have heard about it in the media. And basically, it'll enable the banks to be more optimize their balance sheets, return on equities to go up, and as well as be better positioned to serve clients. So we think that's a very important factor today in terms of regulations. Number two, regulations in terms of M&A, right? So companies now, we've seen a number of mergers. M&A is up 15% year over year. And we're seeing the benefit of kind of the pass-through, the being blessed by the executive branch in terms of wanting to ramp up inorganic growth. And that's good for the companies outside of the banking universe. But in terms of advice, banking revenue, that's a great piece of it as well. And then the last thing is that as banks look to finance companies, there is more interest in terms of funding projects locally in the US. And so we're going to see that demand, and that will require more demand for debt, capital financing, et cetera. And so that's another tailwind in terms of this overall change in regulations.
Great, thanks. And since you mentioned M&A, I'm sure our audience would love to hear your thoughts on the recent announcement with Fifth Third.
Right. So, I mean, we're jumping right into what should be a pretty pronounced consolidation in the banking field. Yesterday, Fifth Third announcing they're acquiring Comerica. Not necessarily a surprise in terms of Comerica being acquired, but interesting tie-up and very clever the way it was done in terms of a company acquiring a 2 times book, acquiring for a share exchange at 1.7 times. And so no real book dilution there. They're going to pick up about 850 million of synergies. So nice earnings accretion for that combined entity. And then it should be closed. They expect it by the first quarter of 26, which just shows you how the regulatory authorities are pushing through deals and helping out the whole process. And so that's a further catalyst, I think, for embedded deals that exist today. And we know that consolidation needs to happen. There's 4,500 banks there. And so we need more scale and opportunity to combine geographically as well.
Great. So now I'd love to touch on the yield curve and the Fed outlook. What are your thoughts there?
So everybody always asks about the yield curve, and I'm not so sure that I know it any better than anybody else. But a few thoughts for us in terms of it does matter in terms of understanding the rate structure, the rate curve, et cetera, in terms of the flow through to financial services. And what I would say is that, I think given where we are today, we peaked out at Fed funds at 5.25 to 5.5. We're right around 4 to 4.25. We expect a rate cut this month, no cut in November, no meeting, and then in December, probably likely we'll get another 25 basis points. And so that will get you to 375 to 350 in terms of the actual environment. And we would expect another 2 cuts over, say the 26 period to be determined. But then that would get you to the neutral rate around 3%. And I'm not so sure about the timing of that, but we feel pretty good about the trajectory of that Fed easing process to get to that point of 3% over the next year. And one thing that we do look at is kind of the alternative credit market. So you look at the 2-year Treasury today, that's at 360, and that's kind of a leading indicator of where Fed policy should go. So we feel pretty confident that the credit markets are anticipating those easing actions by the Fed. And so we look for that in terms of a guide. And then, in terms of overall rates, it's different how it actually translates into the financial services impact. Right. So if we have the bank structure and it's, a short-term rate, now we get to 3% lending rate at 6%. That's a really nice environment in terms of the yield structure for lending and building your balance sheet. So that's very healthy for the banks. But if you're an insurance company, you like to see short-term rates be a little bit higher, which we had a couple of years ago. Think of Berkshire Hathaway with over 300 billion of treasuries. At 5%, that's pretty significant. But when you're talking about short-term rates being 3%, that's an impact. So, that's a headwind for insurance companies, but to offset that, they need to build their balance sheets through float and premium writing. And so that's one aspect. And then the last thing is we follow alternative companies like KKR and Blackstone, et cetera, and they want the most lowest cost of capital they can get. And so that's an important aspect to running their business, to turning over their portfolios, et cetera. So there's lots of nuances with respect to the rate curve, how we employ it, and then thinking about the construction of the portfolio.
Okay, great. And are you concerned about any issues with credit?
Every day. We always are very keen to changes in credit. That is one of the biggest determinant of earnings impact. And so it's a big component. And, we've kind of been in this semi-volatile component for the economy in terms of this year, in terms of the GDP fluctuations and so on. But overall, we think the trends are pretty good when we get feedback from American Express, or Capital One, or some of the trust data, Bank of America. Overall, it seems like the core U.S. consumers in pretty good shape. Delinquencies are sort of stabilizing here. And, we've seen some pickup in some of the retail spend more recently. There continues to be some stress at the lower end, the subprime. We did have a bankruptcy in one of the subprime auto lenders, about 10 billion. So that was kind of a hotspot that popped up and, impacted spreads and so on. So I do think for our naive economic approach, we do look at employment. We track that very closely as a leading indicator for credit. And for the most part, that's been fairly stable, maybe creeping up a little bit. So that's on our radar. But for the most part, we feel pretty good about the credit outlook.
Okay, that's helpful. So we already touched a little bit on the recent bank merger, but what is the fund's exposure to banks?
So it has generally been pretty consistent, but at the moment, it's about 20% exposure. And I would say at the moment, we have favored the larger institutions, JP Morgan, Wells Fargo, et cetera. We like the money center banks because of their stable deposit base, more competitive funding rates. So Wells Fargo, for instance, at 150 basis points, probably the most competitive in the industry. And then these institutions also have big wealth and asset management groups, fee-based programs through investment banking, capital markets, et cetera. So they're very diversified in terms of revenue. And then certainly with the JP Morgan, the best capitalized in the industry. So overall, over the last couple of years, we've favored those institutions, probably a little less sensitive to changes in NII in terms of this yield curve versus the regionals. but overall, we think they're more competitive platforms, and we've been in there. One company that we do like is First Citizens, a little bit smaller. They were the ones who took over Silicon Valley Bank. That's trading around tangible book today. They have a huge $4 billion buyback in place, $20 billion market cap. And so they see a lot of opportunity in their own stock at this moment, which we find attractive. And when you think about bank deal yesterday going at 1.7 times tangible, and First Citizens, which is a world-class institution, trading around tangible with the company buying back shares and being such great allocators themselves, we think that's a pretty good opportunity.
Yeah, sounds like it. So going back to the theme of the American Tailwind, can you talk more about the aging of the population and what that means for future wealth transfers to younger generations?
Right. So this is a big super theme that we follow, and has a number of derivative impacts. And I think everyone's aware of the baby boomer and the wonderful approach to saving and investment that they've done over time. And, as they rise, their portfolios, their retirement plans, their household wealth, et cetera, will be transferred to younger generations. And so on a very technical side, they're mostly in retirement funds and at this point, probably fixed income for stable income. And so as that comes out, there'd be demand for fixed income, but then that moves to the younger generations. And over the next decade alone, we see an average of 1.6 trillion of transfer of wealth. So 16 trillion and even more than that over the next 25 years. And so you think about this next generation of services to the younger people. What do they want? Do they want more of an app platform? Do they want more education? Do they want more access to stocks, portfolio managers, ETFs? We can get into tokenization, et cetera. So we're looking for companies that can basically retain that wallet share, service this new generation, and then also the companies that may be more innovative at this point that are taking share from platforms. So we feel pretty good about the opportunity at Charles Schwab, Interactive Brokers. And so especially with this engagement in the markets, much more influential in terms of the engagement. When I went to school, we would have to call in our trades on the phone. I would get Barron's on the weekend. Today, it's the instant advice that you get on the app. So very, very different environment. And we just have to be very cognizant of which business model is going to succeed in terms of that transfer.
Absolutely. So on the theme of changes in technology, we talk about AI all the time. Can you talk about how AI will affect financial services companies and how you're thinking about that in construction of the GABF portfolio?
Right. So I'd just like to put out two more super pieces to this at very high level. So first of all, the AI spend that we've seen in terms of the outlook, and this can take many years, but they're talking about between $4.5 to $5 trillion. In today's dollars, the World War II spend was about 5 trillion. So on any case, this is going to be a significant spend, and that will have different demand for lending, credit, et cetera. So that's one aspect. The other aspect is that what it's bringing to the environments like financial services, and that is an acceleration in automation and standardization of processes. And this has been ongoing thing that's going on for years. And if you think about a Bank of America, they are servicing with half their employee headcount from a decade ago, but almost double the balance sheet. And so what AI is going to do is accelerate that efficiency gain and processes to serve customers, to leverage deflation within your technology stack. And so these will have very big impacts. And why? Because firms like Bank of America, they have huge installed technology platforms. They have huge customer engagement. And so there's the need for reach out in terms of specific customer engagement and customize the approach, as well as wealth advice. You can think about it on a number of ways. So the financial services companies are uniquely positioned to benefit from this tremendous increase in productivity that's going to come. And in terms of employment, I think we were talking, Peter Lynch yesterday talked about AT&T, for instance. In the 1980s, they had 1 million people working for them, and there was 100 million of workers in the United States. Today, there's 160 million of workers in the United States, and there's only 140,000 people that work at AT&T. But you just think about the throughput of the technology, the systems, the technology, all that stuff, and how productive that is. So the reality is, as this AI comes, it will directly benefit both the financial services operations themselves, shareholders through higher returns on equity, and also the clients, more capabilities, better advice, better risk management, et cetera. So I see the financial services business as being a particularly good segment for participating in the AI spending, as well as a good risk component because we have low multiples as well. So, our in JP Morgan trades at 15 times earnings, and here they're spending $8 billion on investment spend. So I think that's a great opportunity within our space at a lower multiple.
Really interesting. That AT&T stat is wild. So we've touched on a couple of the portfolio holdings. Can you share another example of a position in GABF and why you are holding it?
So one of my favorite companies is almost the first company that I talk to our interns when they come in about is W.R. Berkley. And it's not necessarily a household name, but it is an incredible business. And what I often tell investors is go to page 8 of their 2024 annual. And on that page, they outline their entire return profile from the 1974 right up until present. And when you add up the cumulative return over that time, it's about 23% CAGR. And during that time, the S&P, as we know, is about 12%. So this company over 50 years has CAGR'd at 23%. And that is a function of being in the insurance business, which is a dynamic cyclical business where you allocate capital both to underwriting premium for opportunity, or you buy back your shares in your company, or you issue a dividend. And so there's just a number of ways in terms of being flexible about capital allocation. And this company has just been incredibly unique in terms of their execution over time, as well as their positioning going forward. And they're on their second generation of CEO in terms of this Rob Berkley. He's a fantastic, and he talks like his father, he executes like his father. And so we feel really comfortable in terms of the core business, what they do and how they execute on it. And we don't see the insurance business changing materially in terms of the overall approach to capital allocation. The technology, markets, all of that will change, but just the core approach of understanding capital opportunity will stay the same. And then I would say the catalyst for W.R. Berkley today, in addition to being a great business growing nicely, is that this spring, Mitsui Sumitomo announced that they're going to be buying 15% of the outstanding shares over time. It will be a step process as they get state approvals, subject to market conditions, et cetera. But we feel pretty good that a major Japanese insurer is coming over, aligning with W.R. Berkley. There's no share dilution, and they're becoming one of the largest shareholders in the company. And so we think that's a great confidence in the future by obviously an informed Japanese insurance company.
Great. Thanks for sharing that detail. So you often talk about entrepreneurial mindsets in your investor letters. What is it, and why do you look for that characteristic in management teams?
So I just love studying that entrepreneurial mindset, and started learning about it at Columbia Business School, and then certainly following the teachings of Warren Buffett in terms of his feedback. And we know that that's one of the characteristics that he really looks for, especially in acquiring operating businesses. And I think it's a differentiator in talking about actually best of breed management. And so everybody wants great managers to run their companies. And that's, that goes without saying, but there's a component to this kind of entrepreneurial mindset. And it doesn't necessarily have to be a Silicon Valley startup. It can be a company like BlackRock or Blackstone, or even Berkshire Hathaway, at $1 trillion market cap with 26 corporate officers running the entire thing, right? So, but it's this approach to capital allocation, to intense customer focus, to driving the institution, to having congruence within the employee base, and also a risk management approach too. So taking very calculated, informed risks when you do that. American Express, for instance, went into the pandemic and actually accelerated their spending during that time when you would question, hey, you need to retain capital, the world's uncertain. But they saw the opportunity there to do that, and that has led to huge market share gains coming out of that process, plus a padding for their growth going forward. So I think you want to qualify management in terms of that entrepreneurial, and that's really this top 5% of all companies. And you also see a like-minded amount of feedback in terms of, Berkshire Hathaway, Jamie Dimon, communicates a different. And so there's almost a clubhouse effect of understanding this kind of unique drivenness to commanding companies. And that's something that we really look for. And we think it's a huge proponent, especially with like a W.R. Berkeley, which you have to rely on that compounding over time, as well as that focus. And so it's a big differentiator for and how we look at companies. And it also is just a showstopper in terms of whether we invest as well.
And do you yourself employ that entrepreneurial mindset as a portfolio manager?
Absolutely. I'm fascinated by businesses. I probably have the most curiosity in the firm in terms of trying to understand how things work, going out, learning about small businesses, entrepreneurial ventures. And look, within our own industry, we have mutual funds, ETFs. And so I'm very lucky to be able to helm this portfolio and ETF opportunity too, and being able to launch it and see it grow. So this is my entrepreneurial venture. And I want to take that same discipline approach to running the fund as we would expect of the managers as well.
That's great. Well, thank you for answering my pre-prepared questions. I'd love to now open it up for our audience to submit their questions. So you can go ahead and pop any questions that you have into the Q&A chat and we will get them answered. And some of you I know submitted some questions in advance. So one question that was submitted in advance: as digital transformation accelerates, how do you see regional banks positioning themselves relative to the large banks that are heavily investing in AI for customer service and product offerings? What structural advantages or disadvantages do regionals have in that race?
So this is an important aspect to the consolidation that's going on. And so you think about, as I mentioned, at JP Morgan, $8 billion of technology investment spend, 16 billion total spend, but 8 billion on innovative tech, AI, et cetera. And that is based on there's bigger institutions, certainly scale, technology, learning, et cetera. And so when you're a smaller bank, the demand on being able to be up to speed in terms of offering your applications, your risk management tools, et cetera, will require a lot of technology spend. And certainly at the scale level of JP Morgan, there is a differentiator in terms of that capability. And so what you need to have happen is what we saw yesterday is two banks merging, getting bigger, where they can leverage the synergies of the technology normalized spend, but also be able to reallocate those expenses into the important competitive aspects of having a tech stack in terms of the customer engagement, as well as the risk management tools and AI standardization, as I mentioned. And so that is a big component of the regional trying to be more competitive with the bigger banks. At the very smaller banks, there is a number of firms that we own that actually do the services. So they aggregate all those services, and they are able to buy and offer those to the really small firms who then are able to compete with local apps, their websites, et cetera. But they have to outsource that. And so there's kind of a bifurcated market where you have the bigger institutions leveraging their own vertical in-house, doing very well in terms of that. Smaller banks, kind of competing on those resources, but not necessarily. And then the regional banks where they're trying to build those efficiencies to compete with the bigger banks, but they have to get bigger to do it. And it's going to be a headwind in terms of that tech spend going forward. So that's one of the reasons we do at this point favor kind of the bigger money center institutions.
Interesting. Okay, great. Additional questions from the audience. What are the biggest risk factors for the remainder of 2025 and then into 2026?
So I think one benefit right now and anticipation. So if we step back a couple of years, we had an inverted yield curve a few years ago, and now we have a more normalized curve. But back then, when an inverted yield curve, we had pretty low multiples on bank stocks. A lot of them were trading just over tangible. We had some banks actually were trading below tangible book value. So very low expectations, a more benign kind of credit outlook and rate outlook in terms of earnings growth. We've now moved forward and we have a steep yield curve. So there's anticipation now with the Fed lowering that you'll have a greater opportunity in terms of that spread, the reoptimization of balance sheets. And if you think about a Bank of America that's still lugging around $500 billion of really low yielding mortgage securities, about less than 2.5%. To the extent that they could move those off in a lower rate environment and then reinvest those, there's a nice uplift in net interest margin. So I think one risk is that if we do get more sticky inflation, we do have less accommodative Fed, and then you had more of a flatter yield curve. I think that would go against the current expectations today of what I've outlined, and that would be a potential earnings headwind relative to expectations. So I think that's something we're paying attention to in terms of what is the feedback coming out of 4Q in terms of the NIM outlook going forward. And then the second piece of that is the balance sheet component. So we've had fairly flat loan and deposit growth, I would say, over the last couple of years. We've started to see deposit growth pick up more recently, so that's a benefit from seeing the economy. Loan growth has still been sort of anemic, but it's getting better. I think that demand for credit will increase. One of the things is the big, beautiful bill where they accelerated the 100% bonus depreciation. So that's going to help cash flow. That's going to incentivize projects, and that will create more demand for credit and lending and banking services. So if that plays out, it's a pretty positive environment for banks. But where we could have some issues is if we have more pronounced inflation, the credit environment changes. That I think relative to where we have a valuation today, that could be a disappointment.
Got it. Okay, so another one of our pre-submitted questions from the audience. Notice that American Express is a holding in GABF. Can you talk about the news about the American Express Platinum Card and the refresh, and how you're thinking about the stock in light of that news?
So one of the great things about being a research analyst at Gabelli Funds is that we are really encouraged to get into the products. And with financial services companies, you can't just, there's really intangible in terms of the corporate headquarters. But it's very important to understand the products. And we were very excited to find out about the Platinum Refresh. Somewhat anticipated at the beginning of the year. We didn't know the timing. It came out about a month ago. And so what that means is we took apart and we went in, we looked at the value proposition, and the card fee went from $6.95 to $8.95. So an increase of $200, which is pretty significant in terms of the card fees. And so that's a good tailwind for American Express. But within that value proposition, they enhanced a lot of the features. They added a $400 credit for Resi. So if we look at the engagement by the younger generation, which is the bulk of the incoming new card members, is an attraction to restaurants, excuse me. And so this was a great value proposition to inject there. And so you thought about the overall fee growth going up $200, but then giving back $400 in terms of value injection was a pretty good deal. And so we spent a lot of time digging into this. We like what they've done. They've been very innovative in terms of some of those features they've added. And then the tech stack behind it, I've already used it in terms of seeing the rebates, et cetera, for some of the things I've signed up. And it really is very clear in terms of crediting your account for the rebates and so on from that fee. And I think the engagement from this card will continue to prevail. I think they'll pick up share from this. And I'm very excited about the rollout. But it was also fun to kind of get into the card dynamics as well.
Yeah, and don't forget the $75 quarterly Lululemon credit.
Yes, so that's why we have a family plan.
There you go. Okay, more questions from the audience. What impact do you think the influx of retail investors will have on the overall market and valuations?
Oh, that's a great debate. I don't, it's interesting that you hear from the Robinhoods and the retail bases, TD Ameritrade, Charles Schwab, they really champion kind of the retail knowledge of the market and understanding their education and being, good timers and understanding of balance of their own risk analysis. But traditionally, the market sentiment is that no, the institutions are more informed, they understand the cycles better, they're closer to the companies, et cetera. So there's always this, I think, debate. I'm not so sure what the answer is, but the reality is that investors in the market, whether they're retail or institution, are still subject to the Jesse Livermore highlights from 100 years ago in terms of greed and fear, right? And look, the markets have done very well this year in terms of being up 13, 14%. There are a number of companies, as we know, that are up, multiples of that. So to some extent, there have been certain asset classes that have just gone vertical, and in some cases for good reason. So there's this debate today. So I wouldn't necessarily rule out, retail versus institutional impact today or whatever. And this is not really a subject that's that helpful in terms of managing the overall portfolio, because we're more keen to the value proposition that the companies have in terms of their cash flow, their fundamental outlook, and how they're positioning themselves. But I will say that the level of engagement today is up, and that benefits companies that we own, like Interactive Brokers, who have a tremendous platform, low cost. And here's a company that's been growing their client count at 30%, their engagement, their offerings, et cetera. They're broadening their offerings to go more global. The tokenization is coming. So I would say the democratization for retail investors is alive and well. And the opportunity set within the different asset classes and companies is still quite there. And even though we have some companies that have, absolutely gone vertical, we still see very good, compelling value within our own portfolio, as I mentioned, in terms of the discount, in terms of price earnings ratios versus the traditional S&P 500.
Great. Next question from our audience. Berkshire stock has been in the penalty box since his announcement at the annual meeting. Do you see that as it being overvalued in Q1 or investors trimming due to Warren's announcement?
So the beginning of the year, Berkshire actually outperformed significantly. And I would say at that time, we felt it was probably, fully valued. Now, we don't get too much into the short-term fluctuations of $1 trillion company. We do have our buy levels in terms of understanding that when that discount to intrinsic value, and then obviously the signals from Berkshire are very important too in terms of their buybacks. And we know that they've been on the sidelines in terms of buying back their stock. So that's a great indication of whether we're understanding the company as well as Warren does. It's still a great company. And if you think about the Berkshire insurance business, we've seen a little softening of market conditions in terms of reinsurance, in terms of premium. You do have rates start to roll over, so that will impact ROEs there and underwriting. And then just having such a massive hoard of cash, we're going to see the decrement there. But what I would say is that the opportunity costs for a firm that's $300 billion of cash at this point earning less than 4% on that, when that is converted to operating earnings or when that is put to work in terms of portfolio companies, I think you'll get that, and over time you've seen the effects of that. So they're very patient, lots of great opportunities. There will be some volatility in the future, and I'm sure they'll be there to take advantage of it. And now you have next generation in terms of Greg Abel coming in with the same approach to risk management and capital allocation as Warren. So we feel pretty good that Warren will continue to be around as chairman for the next few years, but also the new acting CEO this Christmas in terms of Greg Abel doing a good job. And we just saw the deal with OxyChem, and then leaving the preferred there at Oxy being pretty good for perceptions around it. So the 10 billion doesn't really put a dent in the 300+ billion, but it shows that they're engaged and that there's opportunity.
Awesome. Do you agree with Paul Tudor Jones? Does it feel like 1999? Several companies buying equity in each other rhymes with the past. Your thoughts?
Well, again, I refer to people to Jesse Livermore's book, which was written over 100 years ago. And it talks about the tape readers, the fear and the greed. And look, those cycles will continue to happen. And I think it's our job to just maintain proper risk management within the portfolio, to find good value, and to be aligned with businesses that are fundamentally progressing and through a myriad of financial conditions. We can't predict the stock market volatility. That is obviously more than the actual underlying economic volatility of the U.S. economy, or even companies such as American Express, where you see the almost a 50% movement in their stock each year. But the reality is that their trajectory of their business, whether it's a 10% top line, mid-teens growth, great business acquiring metrics, But meanwhile, the price flies around for a number of reasons. So I think I'll leave the judgments about market timing and conditions and all that. But I can be sure that we still take that intense approach to finding the right price to value in terms of the portfolio companies that we're using, and to make sure that within kind of the movement in the economy that we're actually getting the value that we expect in terms of the fundamental growth of that earnings power going forward.
Great. What are unique competitive advantages of the Gabelli team in earning alpha?
So we have a wonderful research team here. We've always been research driven, 40 plus investors, portfolio managers, analysts. We meet every morning, and obviously under the leadership of Mario Gabelli, a very intense meeting. He takes a great approach. He's the last one to turn the lights on, the first one to turn the lights on in the morning. And so it's a wonderful room to be in terms of sharing intellectual content, pushing yourselves. And for a person that follows Berkshire Hathaway, it's important to have a great supporting team in the utilities, railroads, consumer, et cetera, housing. So we draw on a terrific group of analysts and portfolio managers, intellectual capital, and we do a host of industry conferences as well, where we bring together industry experts to kind of inform us. And so we're very close to our companies. We take that ethos, research first. And also, when you get to those morning meetings, there is a high degree of accountability in terms of being there, focused, understanding your companies, understanding the facts about them, and also, the engagement that you get with the other analysts as well. So it's a very rich environment for intellectual capital and a very creative universe in terms of developing and supporting what we need to run an efficient portfolio.
Great. Okay, last question, and then we'll wrap it up here. Do you see any particular sectors trending more towards value at the moment?
So I don't want to speak too much about we have a number of sector offerings, which are terrific. I would say that I continue to champion what we're doing here within financial services. As I mentioned, we tend to have lower multiples, but I said with the companies we've assembled, superior earnings power as well. And also a great backdrop in terms of some of the catalysts that we talked about and tailwinds in terms of the big, beautiful bill and 100% bonus depreciation. So, there's several sectors that you can be exposed to. And I just think we have a great opportunity in financial services. And then at the end of the day, it's not just about the sector, but it's about owning great American companies, whether it's Berkshire or American Express, W.R. Berkley, MasterCard, Visa, et cetera. These are outstanding, incredible companies. We're lucky we have them in the financial services sector, and they're going to power gains for our shareholders going forward.
Great. Thanks for answering mine and our audience's question. If you have more questions for Mac or about GABF, you can contact us here at 1-800-GABELLI or ETF@gabelli.com, and our team would be happy to share more information about the Gabelli Financial Services Opportunities ETF, GABF, as well as our other ETF offerings. We also encourage you to visit gabelli.com/ticker/GABF to learn more about Max ETF. We will follow up with an email with the fact sheet, as well as more information on how to get in touch with us, how to purchase the ETF, and a replay of this webinar. Thank you for joining us today.
McCrae Sykes is a portfolio manager for the Gabelli Financial Services Opportunities ETF, GABF. This webcast is an excerpt from Gabelli TV that appeared on October 7, 2025. GAMCO is providing these links as a matter of general information. We do not intend for these links to be a complete description of any security or company, nor is it a research report with respect to any of the companies mentioned herein. Shares of this ETF are bought and sold at market price, not NAV, and are not individually redeemed from the fund. Buying or selling ETF shares may require additional fees such as brokerage commissions, which will reduce returns. These additional risks may be even greater in challenging or uncertain market conditions. Returns represent past performance and do not guarantee future results. Due to market volatility, current performance may be lower or higher than the performance data quoted. Investment return and principal value will fluctuate, so, upon redemption, shares may be worth more or less than their original cost. To obtain the most recent month-end performance information and a prospectus, please call 800-GABELLI or visit www.gabelli.com. Financial services companies operate in heavily regulated industries, which are subject to change. The underlying securities are subject to credit and interest rate sensitivity risk, which could affect earnings. Additionally, since financial services firms are correlated to GDP, a decline in the economic environment could impact profitability. You should consider the ETF's investment objectives, risks, charges, and expenses carefully before you invest. The ETF's prospectus is available from G. Distributors, LLC, a registered broker-dealer and FINRA member firm, and contains this and other information about the ETFs, and should be read carefully before investing. To obtain a prospectus, please call 888-GABELLI or visit https://www.gabelli.com/funds/etfs/intro. Distributed by G. Distributors, LLC, a registered broker-dealer and FINRA member firm. 1 Corporate Center, Rye, New York, 10580.